Hello, it's Greg Hammer from Hammer Financial Group, and I'd like to spend a few minutes with you today talking about leaving a legacy without leaving a tax bomb. So, what is a tax bomb? Specifically, what I want to chat about today for a few minutes are assets that are pre-tax, like your IRAs, your 401ks, 457 plans, things that will require a 100% tax implication or impact your beneficiaries in that way. So the big challenge is under the Secure Act. So anybody that passes away or did pass away after 2019 and moving forward, the way these payouts would be structured changed dramatically. So everybody used to be able to, for the most part, stretch out the payments over their lifetime. So now there are specific eligible designated beneficiaries, and there are a lot of non-eligible situations where people must take those payouts at a much faster rate. So let's talk a little bit about those and talk about the significance of that. So basically, your non-designated beneficiaries, like the old way in the old rules, the estates, the charities, the non-qualifying trusts, a lot faster impact. You have to have it paid out by the end of the fifth year. So any of those pre-tax assets would, could not be retained in that previous IRA structure for a period of longer than 5 years. Then your non-eligible beneficiaries under the new law are required to completely empty the beneficiary IRA by the end of the 10th year. And it will require distributions throughout those 10 years if the owner, the individual that had the IRA originally, was beyond what they call the required beginning date, which for all intents and purposes under today's rules, RMD age is age 73. So by April 1st of the following year, if that owner had passed away beyond that date, not only is that beneficiary required to empty those accounts entirely by the 10th year, but they must maintain a minimum distribution based on the single table rate. So very, very important that they continue to do that. Now the challenge there obviously is those people might still be high income earners, right? They may still be working. It could impact their current situation differently than if they were able to control or delay those types of benefits. There are still a few eligible designated beneficiaries that can inherit the IRA and still stretch it out over their lifetime. One specifically is the spouse. So a spouse can create an inherited IRA. They can maintain that stretch over their lifetime. They can also assume the IRA as a spouse, in which case it's like it is their IRA, and they don't have to worry about any distributions whatsoever over any time horizon, regardless of when the original owner passed away. So spouses still have a lot of flexibility, basically the same type of payout options and ownership options as they did previously. Then you have some other eligible designated beneficiaries, but again, very, very limited. The eligible designated beneficiaries are minors, chronically ill, disabled, and then individuals that are not more than 10 years in age difference, meaning younger, or if they are older. So if they're close in age to the original owner, they can go ahead and stretch again over their lifetimes. But the big challenge is, whether you're stretching this or whether they're required to pay it over 10 years or whether they can assume it, it is going to be creating tax implications for those beneficiaries. It will be 100% taxable at their current rate. It could impact things like Medicare. If it creates too high of an income, it could cost them possibly to pay higher Medicare Part B and Part D premiums. It may impact taxes on their Social Security because the additional income that they're required to take out might create what we call a provisional tax implication on the Social Security, and what was once non-taxable may be taxable under the distribution period. So what are some of the things that we can do to actually reduce or avoid that tax bomb? And I'm going to go on a very, very high level with some of these, but one of my favorites is looking at Roth conversions. Why? Today is one of the most favorable tax brackets that we've had in decades when it comes to the standard rate table. So the idea simply is, what value could I create by paying taxes today in a favorable tax bracket, and you can control those as the owner, where likely your income is not going to be impacted as much as a potential beneficiary, where we could pay the taxes today, and then those beneficiaries, whether they be kids or significant others in your life, would be able to receive those 100% tax-free, and they would be able to maintain that tax-free status for up to 10 years. They wouldn't be required to empty that for 10 years, and they would not be required to take any type of distributions throughout that 10 years as well. So there's a lot of value in looking at Roth conversions for those beneficiaries, and they could even potentially create tax benefits for you during your lifetime by reducing your minimum distributions. So really a good avenue to explore to help mitigate taxes. Second thing that we consider is life insurance. When you look at life insurance, it is 100% tax-free upon death to beneficiaries. So again, there's different strategies you can implement. You can use insurance to pay for the tax liability of certain assets like your pre-tax IRA, or you can aggressively take distributions and put them into the life insurance, assuming legacy is your primary concern, and fund that life insurance benefit to create a very tax efficient funnel to your beneficiaries. Again, 100% tax free. Another option, if you have charitable intent, you give to charities, you make donations, you have those interests in your life, and like dedicating parts of either your income or your assets to those types of concerns. You could utilize the IRA if you are over age 70 and a half in what they call a qualified charitable distribution. What's the difference between just taking a distribution and making the donation? Well, if I just make a donation to a charity, I'm still subject to the itemized deduction schedule. So you may not receive the full value of the deduction of the contribution, right? Because you have to get beyond that standard deduction rate. Where a QCD would go directly to that charity, and you would be able to reduce your income 100% of that donation to that charity. So it's a top line revenue deduction. So very, very powerful if you have some type of charitable intent. And what that would again allow you to do is reduce the amount of the asset remaining in that IRA, potentially leaving other assets like non-qualified brokerage accounts, savings accounts, CDs, other investments that would carry tax preferential treatment to those beneficiaries. Finally, trust can be a useful tool. Just have to be very, very careful with trusts. If they're not set up properly, and you fall into the trust tax rate, those tax implications can be much greater than the individual would have. Trust tax rates in a very, very short amount of income fall into the highest federal tax implication that exists on the standard rate table. So you want to make sure you consult a professional if you're utilizing them to pass on the IRAs because you have a concern about control of that asset. You want to make sure that that see-through trust is set up properly and that it's not going to create unwanted tax implications at a rate much higher than the beneficiaries would receive individually. So again, the trust can be very, very useful too in stretching that benefit out and for all intents and purposes, mandating that your beneficiaries spread that out as opposed to taking it as a lump sum. So those are just a few things that you can consider. What we recommend is kind of take inventory of your pre-tax retirement accounts, kind of estimate what you would owe if something happened to you today, and then talk with a financial advisor or tax professional that could explore options like the ones that we discussed here today that could create a lot of tax mitigation for your beneficiaries and likely create some benefits for yourself during your lifetime. So at Hammer Financial Group, we help families just like yours create tax-smart legacy plans every day. If you want to better understand your options and avoid leaving behind a surprise tax bill, we'd love to talk. You can schedule a call through our website or give us a call directly. We're here to help. Thanks for watching. Take care.